Hey there, Acctvocab family. Let's tackle an important accounting concept, accumulated depreciation. In just 2 minutes, you'll know what it is, why it matters, and how it works. Let's get started. What is accumulated depreciation? Accumulated depreciation is the total amount of an asset's cost that has been allocated as an expense since it was put into use. Think of it as a record of how much value an asset has lost over time due to wear and tear or obsolescence. How does it work? Here's how it works. Every year, a portion of an asset's cost is recorded as depreciation expense. This amount is then added to the accumulated depreciation account. Over time, the accumulated amount grows until the asset reaches the end of its useful life. Why is it important? Accumulated depreciation helps businesses 1. Accurately reflect an asset's book value, which is its original cost minus accumulated depreciation. 2. Track how much value has been used up over time. 3. Comply with accounting standards like GAAP or IFRS. Example of accumulated depreciation. Let's say your company buys equipment for $50,000 with a useful life of 5 years. If the depreciation expense is $10,000 per year, after 3 years, the accumulated depreciation will be $30,000, and the book value will be $20,000. And that's the gist of accumulated depreciation. It's a key concept for understanding an asset's value over time. If you found this helpful, smash that like button, subscribe to Acctvocab, and share this video with your friends. See you in the next one.